Okay, John, today's question comes from Brian. This is a good question, too. He says, could you talk about how both kinds of special needs trusts are treated at tax time?
Yep.
I'm absolutely going to let you take that one.
No, you don't want that?
I don't want anything to do with that one.
All right. So, quick rehash, 2 types of special needs trusts, generally speaking. You have your first party trust. Mm-hmm. This is where the disabled beneficiary is creating the trust for themselves with their own assets.
Okay.
Now, when I say creating it for themselves, it might be created by a court for them. It might be created by a parent for them. But the fundamental part is that the disabled person's own assets are what are going into the trust.
Yeah.
So that's where we get the first party type trust.
Okay.
Yeah. Then you have the third party trust. A third party trust, the typical scenario is parents creating a trust, funding that trust with the parents' assets for their disabled child.
Gotcha. Yep.
Right? So it's third party.
Right.
One person to another. All right. So first party trust. When a person, generally speaking, if you take your own assets, you put them into trust and name yourself as the beneficiary of that trust, whether that's a special needs trust or any other kind of trust. You can see this same type of trust in the domestic asset protection trust, for example, where I create a trust, transfer my assets into that trust in order to shield those assets from my creditors. Right? But same concept with the special needs trust. A first party trust like that is what's called a grantor trust.
Right.
Grantor trusts are invisible to the IRS. All of the income is reported to the grantor and on the grantor's personal tax return, even if it's not distributed, right? So if that first party trust earns $100 in interest, then that disabled beneficiary is going to have a tax return that's going to show $100 worth of interest taxable to them on their 1040. Now, that first party trust is probably still going to have its own tax ID number, and it's still going to file a tax return. That tax return is the 1041. But a 1041 for a grantor trust is exceptionally simple because basically all it's saying is any income reported to this tax ID number for this trust, IRS be looking for those same numbers on this person's Social Security number and their 1040.
Yeah.
Right? So it's a very simple return. So that is your first party trust. Your third party trusts, it's a little bit more complicated, but not really. So generally a third party trust, if let's say, Devin, you're creating this trust for your child, right? Your disabled child. Well, so first of all, you might actually start out with that being a revocable trust. Right? You want to be able to put some money aside for your disabled child, or maybe even have a place where others, like your parents or somebody, they call you up and say, hey, we want to give little Timmy $1,000. And you say, well, you can't give it to Timmy because he's on SSI, but you can put it in this special needs trust, right?
Right.
That you created, and it's funded with other people's money, not little Timmy's, right? But while you and your wife are alive, you want the ability to change this or amend it, possibly even revoke it altogether if for whatever reason, right? So if it's a revocable third-party trust, it's going to be a grantor trust to you, the people that created it, meaning that all the income, even though it's for the benefit of Timmy,
right,
you are going to report all of the income that is earned on that trust on your personal return. Then you have irrevocable third-party supplemental needs trusts. Now, the typical irrevocable trust is taxed as a trust. And trusts have their own tax rates, which are the same percentages as humans, but you get to the higher percentages faster.
Very fast.
Very fast.
Yeah.
And third-party trusts or irrevocable trusts like that also typically have no standard deduction.
Right.
It's $100.
Yeah.
Is the standard deduction for a typical irrevocable trust. Now, But when we're specifically talking about a third-party supplemental needs trust or special needs trust, typically that trust is going to meet 3 categories, and I've got them pulled up just so I don't misspeak here. But the trust must be irrevocable. Mm-hmm. It must be established for the sole benefit of a disabled beneficiary. So sole benefit, right? This is not a trust for Timmy and his brother Sam, and Sam's not disabled, right? This is for the sole benefit of the disabled person. The disabled beneficiary must be under the age of 65 when the trust was created, and the beneficiary must have a disability that is included in the definition of disabled under the Social Security Act, right?
Gotcha.
Now, 9 times out of 10, that's going to be the case.
Yeah.
Right? The exceptions being maybe husband creates a third-party special needs trust for his Alzheimer's wife when he dies or something, right? When she's 85.
Yeah.
But the typical scenario where you're creating it for your kid with Down syndrome, that's going to meet all of those. In those cases, you can elect for the trust to be treated as a qualified disability trust, and in which case it gets a $5,000 standard deduction. And so you still have to fill out the 1041. It's still subject to trust tax rates, but you get this much larger standard deduction. And so unless there's a tremendous amount of money in the trust, it's probably not generating all that much in taxable income. And in which case, a $5,000 standard deduction. If it's getting no more than $5,000 in income, then there's no tax because standard deduction is going to wipe that out.
Yes. Yes.
And there's other costs and such related to that, because in an irrevocable trust like this, distributions are deductions at the trust level and then taxable to the beneficiary. So let's say you've got this qualified disability trust. It earns $10,000 in taxable income. During the year, it spends $5,000 of those dollars on the disabled beneficiary, right? Well, that's gonna be that income. That $5,000 is going to be K1'd to the disabled person. So They're going to show that $5,000 on their personal return.
Yeah.
The retained $5,000 is going to get eat up by the standard deduction, in which case there's no tax at the trust level. Beneficiary, they have their own standard deduction, and so that distribution is probably going to get wiped away as well.
Yeah. Yeah.
So there you go. That's your taxation on your 2 different types of special needs trusts.
Fantastic. And that makes sense. Now, let me go back over what you said was the 3-part test. Number 1, it has to be irrevocable. Number 2, it has to be set up solely for the beneficiary. And the 3rd part was, remind me of that again, so I can.
There was actually 2 more.
So it's a 4-part test.
It's a 4-part test. The disabled beneficiary had to be under 65 when the trust was created.
Okay, right. And then it has to be one of the qualifying conditions.
And they have to be a disabled person as determined by Social Security.
Yes. Okay. Perfect. Brian, I hope that answered your question. For all of our other listeners, if you have questions on trusts and things like that, I'm not your guy, but I know who is. John Ross can answer those for you. Very good. So for your questions, go to bigpictureretirement.com. Up in the top right-hand menu, you're going to see Ask a Question or some such language there. And we'll get that here and look forward to covering that on a future episode. All right. Thanks for listening.